Hello and welcome to Chapter 11 on stock and stock valuation. Hopefully you'll find this to be an interesting chapter as we move from bonds and bond valuation now over to stocks. As you work through this chapter, there'll be some opportunities for you to answer some questions. You'll have some sort of quiz questions pop up and prompt you to see if you can answer them. It's recommended that you take the time to, pause the video, take the time to work through the question, and then resume the video and also see if you get the answer right or wrong. So in this chapter, we'll cover 5 major areas. The first is some general approaches to stock valuation. Then we'll look at dividend discount models or DDMs, as well as discounted cash flow or DCF models, which will also apply to what we're going to cover in week 2. We'll also look at preferred stocks and efficient markets. So for multiple approaches to stock valuation, there's 4 sections here. We're going to start with the price to earnings or PE ratio, which is a major, very commonly used ratio. Then we'll look at price to book ratio or PB ratio, and then briefly discuss some additional multipliers that are used for stock and firm valuation, and then close out with a discussion on price and intrinsic value. So the PE ratio is a very common metric that's used by investors and analysts to determine a company's stock by comparing its market price to its earnings and earnings per share. So if a company has earnings of $3 per share and its PE ratio is 10 to 1, then it would be trading at $30 a share. And you can see some very large multiples in the marketplace. The PE ratio helps gauge how much investors are willing to pay, per unit of earnings or earnings per share, and offer some insight into market expectations. It really comes down to what the individual investor considers to be a value, because you could have stocks that are trading at very, very large multiples, 100, 200 times earnings, which may seem completely unreasonable and which is likely to happen because of hype. You can even have stocks trading at high valuations when they make no money. So they would actually have a negative return, and yet they're trading at, what would be considered, infinite amounts over its earnings. There are sort of 2 variations. There's the trailing PE, also known as a TTM, or has TTM attached to it. So the trailing price earnings ratio is really based on the last 12 months of earnings performance and provides a historical view of the company. The formula is very simple. Price per share divided by earnings per share, P/E, P over E. The forward or leading PE ratio is used to project future earnings. And that can be used for comparing earnings with future expectations. Some companies may provide guidance on what their earnings may be, and analysts are usually the ones that say, okay, we anticipate the earnings or the EPS to be $4 a share, and we can apply the current multiple to those forward or those projected earnings, and that will provide a guess or an estimate of what the future stock price is supposed to be. How accurate it is really depends on so many different factors. A high price to earnings ratio basically indicates growth potential, but it could signal overvaluation, which puts the company at risk of future price corrections. So when you have a lot of hype that drive the price of the stock up to where its price doesn't make any sense relative to its earnings, is something to watch out for. A low PE ratio suggests stability and is often associated with mature companies because there isn't a lot of hype. They've sort of established historically over time what their earnings are and how their price relates to their earnings. You should see a relatively consistent multiple over its earnings when it comes to price, unless there's something anticipated that would drive the earnings or the projected stock price to be that much more than its earnings. And that also then may present potential opportunities for stock price appreciation. But it really also hinges upon the company's earnings increasing. So here's a basic example. If we've got a common stock of Chemical Corp, it's currently trading at $24 a share, and its EPS for the year is $4. Its price to earnings ratio is $24 divided by 4, which is 6 times. Comparatively speaking, PE ratios become more meaningful when we compare them across time, industries, or peers. So you could have 2 companies in the same industry, Ford and General Motors. You would think that they would have similar PE ratios, but they may not. If we rely on standalone PE ratios without any kind of insight or benchmarking, then they're really kind of meaningless. Let's take a look and compare the PE ratios of a few different companies. So here's Royal Bank of Canada, and its most recent stock price just a couple of days ago was $172.09, and its price earnings ratio is 15.28 times its earnings per share. If we look at Canadian Tire Corporation, also a very large company, its recent stock price was $153.31. Its PE ratio is 22.34 times. Here's Shopify, so a tech company. It's not nearly as old as Royal Bank of Canada or Canadian Tire. Its previous stock price was $80.39, but its PE ratio is 82.96, so almost 83 times its earnings. So when you compare Shopify to the Royal Bank of Canada, which is an established institution, I believe well over 100 years old, and has a market capitalization of $243 billion, which is over twice the market capitalization of Shopify at $103 billion, does it make sense that Shopify is trading at 83 times earnings versus Royal Bank of Canada's 15 times earnings? Let's also look at Microsoft, another tech company. It's been around for quite a while. Its previous close was $431.95. Its PE ratio is 36.88, and it pays a dividend. In fact, all three of the other stocks pay a dividend, except that Shopify doesn't. So again, what's the justification for a much younger tech company with a market capitalization far less, by the way, of Microsoft, because Microsoft has a $3.24 trillion market capitalization, as Shopify's market cap is $103 billion, and it's trading over twice the price-earnings ratio of Microsoft. Now, let's look at some of the car makers. Ford has a recent stock price of $10.41, a market cap of $41.7 billion, and its PE ratio 11.97. General Motors, $51.55 stock price, a market cap of $57.2 billion, PE ratio of 5.55. So it's trading at 5 times earnings. Ford is trading about twice that at 12 times its earnings. If we look at Toyota, which is also an established automobile manufacturer, this is trading in yen, and I don't know offhand what the conversion is, so let's not worry about that. But if we look at the PE ratio, it's 7.37 times. And it, along with Ford and GM, all pay dividends. Ford has the highest dividend yield. General Motors the lowest. So if we look at Tesla, which had a stock price of $259.52, its market cap is $820.9 billion. Why that is so much higher than Ford and General Motors, of course, is based on the number of shares times the stock price. So lots of shares, high stock price. And it's trading at 71.83 times its earnings. So you compare Tesla, which is a much younger company producing only 5 models of vehicles. Yes, they're into solar and some power and batteries, but trading at well over what their peers are trading at in terms of price earnings ratio. And you must ask yourself, is that differential justifiable? Is it reasonable? Personally, I don't think so. We do have to be careful though, because there's some limitations and cautions. So the single price earnings ratio really won't capture the full picture of a company's health. So we need to be able to see what its PE ratio is over time to provide some historical context to allow us to predict. And there are some other valuation tools and methods that we could use to complement PE analysis, which would work to mitigate risks that are associated with mispricing, because the price of the stock should be some multiple over its earnings, and if there is very much of a gap between there, then the share could be mispriced. Now we'll move on to price to book or PB ratio. This is also known as the market to book or MB ratio, and this simply measures the company's current market value relative to its book value. And its book value is determined from an accounting perspective. This helps provide some insights into how the market will value a company's net assets, right? Assets minus liabilities, leaving its equity. It's useful for evaluating industries that are very capital intensive or asset heavy, so financial services, real estate, investment trusts. When you start to get into businesses that rely more on intellectual property and intangible assets, then it's really hard to determine what the true value of those assets are on the financial statements. and therefore you really can't have a meaningful price to book ratio. The formula for the PB ratio is the market price per share divided by the book value per share. We can also extend that to be the market capitalization divided by its net book value. So the market capitalization is the total value of the company based on all the outstanding shares. Another term for that is market cap. You would simply take the price per share multiplied by the number of shares. That's the market cap. And you divide by the book value. The book value is the net value that remains if all the assets were liquidated and liabilities were paid off. And that's what you would have covered in your previous prerequisite accounting class. We can also look at it on a per share basis. So the price per share divided by the net book value per share. So we can do it in aggregate and total numbers or on per share basis. So what does the ratio tell us? If we had a PB ratio of 1, that means that if the share was trading at $1, that's equal to its book value per share, $1. Of course, you'll never see that. We do have a PB ratio of less than 1 that can indicate undervaluation, and there could be some hidden problems with the company, and it may signal some potential investment value if the assets exceed the market price. There have been instances, I can't think of any off the top of my head, but where the asset value of the company is actually higher than its share price. Very rare occurrence, but it could suggest that there could be a value opportunity. A high PB ratio, which is more common, may suggest an overvaluation. So investors are willing to pay more than the asset's value. And it comes down to, well, why would somebody pay more than something's worth? And that's a whole psychological discussion. So we don't have the time to do that here. In terms of limitations of the PB ratio, it's really not appropriate for companies with intangible assets, as I mentioned. So if they're technology firms, companies holding patents or trademarks, companies like OpenAI, for example, companies that don't make anything and don't have any tangible assets, this really won't work for. And there's also a lot of variability around the interpretation to what the PB ratio is telling us. It does become more meaningful if we start comparing across similar industries, just like with PE ratio. And again, we would use it alongside other metrics, so we can have a basket of metrics that can help us develop a very comprehensive investment analysis. So now we'll discuss some additional alternative multipliers that we can classify into equity multiples and enterprise value, or EV multiples. So an equity multiple is simply anything that we would multiply over and above the equity. We've already talked about one, that's the PE ratio, and that compares its stock price to its EPS, and that's a good quick evaluation. It's based on profitability. The price to book ratio is also an equity multiplier, measuring the market value relative to its net asset value and is used for asset-heavy companies. We can also look at the dividend yield, which shows what the cash return on investment is as a ratio of the dividend per share to the share price, and that's useful for comparing cash-generating investments. There's something called the price to sales, or PS ratio. So that's the stock price divided by its revenues. So establishing a value of the company relative to its revenue. And that's more suitable for companies that may have losses or unpredictable earnings. So as I mentioned before, where you have situations where a company has no profits, a good example might be some of the cannabis stocks like Canopy Growth. That company never had any profits and yet had extremely high market capitalization and was trading at very high values. So you couldn't assess it based on its price to earnings because its earnings are negative. So you would have to assess it on its price to sales. So how much over and above the sales is the share price? We could also have price to cash flow ratio, or P divided by CF, or PCF ratio, and that compares the stock to its cash flow per share. And that might be useful when we have high non-cash expenses like depreciation that can affect reported earnings. Remember, when we're dealing with earnings from an accounting perspective, that is accounting earnings, and that can include depreciation, gains and losses, things that are non-cash related. The price to cash flow provides a much more pure cash-based perspective of the multiple. There are limitations, though. These only provide a snapshot in time, and we have to interpret them very carefully and consider the specific circumstances of each company. We can't apply these globally and interpret them on a cookie-cutter basis. If you look at enterprise value, or EV multiples, a company's enterprise value is really its total value. So we can Think of it as a more comprehensive alternative to market capitalization because it's not necessarily based on the number of shares times the share price, which can fluctuate quite heavily. So it could be a proxy that we would use. But as you'll see, how we determine enterprise values is based on future cash flows, which we'll get into a little bit after this. So we could take the enterprise value divided by revenue, so that's the EVR. So this will evaluate how much investors will pay for each dollar of a company's sales. These are handy for firms that have varying revenue recognition practices or companies that are in very early stages or startups when the nature of their revenues may differ quite substantially. Another one is EV over EBIT, or earnings before interest and taxes. So this looks at the enterprise value relative to operating profit and excludes interest and taxes. So this gets us looking at it more from an operational perspective, exclusive of financing and taxes, which are out of the company's control. We also have EV over EBITDA, so earnings before interest, taxes, depreciation, and amortization. This gets us much closer to a cash flow base, but not quite. So this compares the enterprise value to earnings before interest, taxes, depreciation, and amortization. And this is used for capital investment analysis and acts as a reasonable proxy for cash flows I just mentioned. Another variation of this is EV over EBITDA-R, which adjusts for rental costs. And this is useful for companies that have significant lease expenses, so like airlines and hotels. And then we have EV over capital employed, which looks at the EV relative to total capital used and highlights capital-intensive businesses. If we're looking for a number for what total capital used is, we could say that that would be the total long-term assets. So now we'll round out this section with a brief discussion around price and intrinsic value, and this will help us better understand how we come up with those enterprise values that are used in the enterprise value multiples. Intrinsic value is the present value of expected future cash flows from either a stock, some other security, or even a firm, and it indicates the fair price for a stock or company. So when we looked at bonds, the whole idea of calculating the present value of those future cash flows were to, in essence, calculate what the intrinsic value of the bond is. Well, in this chapter, we're going to do the same for stocks, and we can extend that to evaluation of companies later on. To help us come up with the intrinsic values, we need an expected return. The expected return for a 1-year period is the expected dividend plus any increase or decrease in the price per share divided by the price at the beginning of the year. We could apply this similarly to the price of a firm as well, where we replace dividends with cash flows. So we could say that the expected return R is equal to D1, or dividend 1, plus P1 minus P0, where P1 is the stock price at the end of next year, P0 is the stock price now, and we take all those and divide by P0. We can actually separate that return into two separate parts, the part related to dividends and the part related to capital gains. So the dividend portion, which we call the dividend yield, we could say is equal to the dividend, D1, the next dividend, divided by the stock price now. The capital gains yield is the difference between next year's stock price and the current stock price. Assuming that that increases in value, we'll have a capital gain. We can also have a capital loss. So we take the difference between next year's stock price minus the current stock price. That'll be the capital gain or loss. And when we divide that by the price, we can turn that into a percentage. So here's a basic example of price and intrinsic value. Let's assume that Blue Sky Corporation, or BS shares, are selling for $75 today. They're expected to produce $3 in cash dividends at the end of this year, and the expected selling price is $81 after 1 year. So what's the expected return on BS shares? And can we confirm that those shares are fairly priced? So we take our return calculation that has the dividend yield and capital gains yield. The dividend yield portion is the $3 dividend, D1, divided by the current stock price, P0 of 75. That's 4%. And then the capital appreciation, or the capital gain portion, is the $81 stock price next year minus the $75 stock price today, divided by the $75 stock price, is 8%. So the dividend yield is 4%, the capital gains yield is 8%. The total return is 12%. We can then prove that the stock price works. If we rearrange the formula, we could say that the price today of a stock, P0, is equal to next year's dividend, D1, plus the stock price, P1, divided by 1 plus R to the exponent of 1. This is actually the formula of the present value of a lump sum, where we have two portions to that lump sum, the dividend, single amount, plus the share price, single amount. So $3 plus 81 is $84, divided by 1.12 is $75, and therefore it works. Now we're going to get into the fun stuff. So this section 2 of the chapter deals with the dividend discount models, or DDMs. It's fairly technical, so there's going to be a bit going on here, but it's actually not going to be too bad. Here is where we're going to talk about zero growth DDM models, constant growth DDM models, also known as the Gordon growth model. We'll look at variable or non-constant growth models, two-stage DDM very briefly, and then round out with some advantages and limitations. So if we start with the zero growth dividend discount model, the whole idea of these discount models, the word discount means present value. So these are different ways that we're going to go about calculating the present value of the future cash flows associated with stocks that pay dividends. So a zero growth DDM assumes that a stock's dividend remains fixed at the same dollar amount indefinitely. Does that make sense? Actually, for certain kind of stocks, it does. We'll see that a little bit later. I'm not going to give it away. So it's a very simple valuation model that will calculate the intrinsic value. Okay, intrinsic value means that this is based on the present value of its future cash flows. So it calculates the intrinsic value of the stock by treating the dividends as a perpetuity. We could say that stock value is equal to the annual dividends divided by the required rate of return. We can modify that to say that the stock value is really its present value, and that's equal to the dividend divided by the discount rate. So the rate of return is going to be our proxy for the discount rate, because investors will discount at their expected rate of return. And we can reduce that even further to say that PV is equal to D over R. So let's kick it off with a very simple example. What's the intrinsic value of a stock that pays $2 in dividends every year if the required return on similar investments in the market is 6%? To solve it, we're going to apply our formula. P0 is the price of the stock now, is equal to dividend divided by R. We'll end up replacing div with D later on. So the dividend is $2. The required rate of return is 6%, 0.06. That gives us an intrinsic value of $33.33. The advantage of a zero growth DDM is that it's easy to use. That's about it. Its limitations are that sometimes there are unrealistic assumptions that dividends will remain constant over a long period. So that means there's limited practical application. However, there is indeed a practical application for them, and that is for preferred shares. So your preferred share, preferred stock, pays dividend that's the same. And we'll talk more about preferred shares and preferred share dividends later on. The second and most common model we're going to look at is the constant growth or Gordon DDM model. So this assumes that a stock's dividend will grow at a fixed annual percentage rate. So it provides a more realistic approach than zero growth. It's not perfect, because what happens is, to expect a company's dividend to grow at the same percentage every year, year over year, may not be reasonable, but at least we can use it as an averaging mechanism. And this is useful for mature companies that have consistent dividend growth over time. All the major banks, the big oil companies, as their earnings increase, they are likely to increase their dividends over time. Some companies will tie their dividend distribution model to be a portion of their earnings. So they may say that, 10% of our earnings will be paid out in dividends. So if their earnings increase fairly regularly, then their share price or their dividends will increase. But because earnings don't increase at a fixed percentage, the dividend might not. But at least this gives us something to work with. So the constant growth model determines the stock value to be equal to the dividend at times zero, so D0, so the current dividend, times 1 plus G, where G is the growth rate, divided by R minus G, where R is required return. So D0 is a dividend that's just been paid this year, the most recent dividend. D1 is the next dividend. So D1 is equal to D0 times 1 plus the growth rate. G is the growth rate and R is the required rate of return. So if we take that numerator where we have the D0 times 1 plus G and say that that's equal to D1, this gets us to a formula of P0 equals D1 divided by R minus G, and that's the Gordon growth model. So here's our first example. Let's say that Blue Sky paid a recent dividend of 2.777 per share. I chose that just so that we get a more exact result. If the company is expected to grow its dividend at 8% in perpetuity, what's the price of the shares if the discount rate is 12%? So I'll stop the video, see if you can figure it out, and then resume. We'll apply the Gordon growth model. P0 equals D1 divided by R minus G. Because we don't know what D1 is, but we know what D0 is, we can calculate D1. So we'll modify the numerator to be D0 times 1 plus G and divide by R minus G. So the current dividend D0 is 2.777. We multiply by 1 plus the 8% growth rate, so 1.08, divided by the 12% rate of return minus the 8% growth rate. That gets us to $3 in the numerator. So that means the next dividend, D1, is $3 divided by 4%, gives us a $75 stock price. If we wanted to, we could also rearrange the formula to determine what the rate of return is if we know what the next dividend is, what the current stock price is, and what the growth rate is. And if you wanted to, if you knew the return, the dividend, and the stock price, you could also determine the growth rate. So this allows us to manipulate the formula to figure out any missing component. So if we go back to this one, let's prove the 12% rate of return, where R equals D1 over P0 plus G. So the $3 stock price divided by the initial stock price of 2.777 plus 0.08 equals 0.12 or 12%. So we know that this works going forwards and backwards. Let's look at a second modified example here. So BS is expected to pay a dividend of $3 at the end of this year. The dividends are expected to grow at a rate of 8%, but we have three investors. Investor A plans to sell at the end of year 1 for $81. Investor B will sell at the end of year 2 for $87.48. And investor C will sell at the end of year 3 for $94.48. So three different investors. If we were in the room, I'd pick three of you. And what we want to do is determine what the stock price is today for each investor, given 12% rate of return. So for investor A, we'll calculate the price based on the next dividend D1 plus the $81 expected stock price divided by 1 plus 0.12 to the power of 1, or exponent 1, $75. We know this because the original scenario was in essence the investor A scenario. If we look at investor B, well, we have to start mapping out what investor B's cash flows are going to look like. So investor B is going to get the dividend at the end of year 1, but also the dividend at the end of year 2. So with the 8% growth rate, D1 will grow to D2 of 3.24. $3 times 1.08 is 324. And we know what the stock price, P1, is going to be at the end of next year, 87.48. So we take $3 divided by 1.12 to the exponent 1 plus 324 plus 87.48 divided by 1.12 to the exponent of 2, we end up with $75. If we look at investor C is going to receive three dividends, D1, D2, and D3, plus the stock price at the end of year 3. So $3 divided by 1.12 exponent 1 plus 324 divided by 1.12 squared plus $3.50, which is a 324 dividend 2 times 1.08, that's 350, plus a 94.48 stock price. So that sum divided by 1.12 cubed. And guess what? $75. So what happens is the stock is worth the same regardless of the time horizon. Of course, that assumes that the growth rate stays the same for all three investors. Let's look at a third example. Let's say that stock sells for $40. The next dividend will be $4 per share. If the rate of return on reinvested funds is 15%, and the company reinvests 40% of its earnings back into the firm, what must the discount rate be, or the required rate of return on the stock? This was a little different. So from this information, the $40 is P0. That's the stock price now. The next dividend, $4, is D1. We don't know R, because that's what we're trying to figure out. And in order to solve this, we need to know G. But we're given these two other percentages here. Well, it turns out that the growth rate can actually be calculated based on something called the plowback ratio. The plowback ratio is simply what portion of its earnings will a company keep versus pay out in dividends. So if a company has a policy of paying out 20% of its earnings in dividends, it retains 80%. So that's a plowback ratio of 80%. So in this case, the company reinvests 40% of its earnings. That's the plowback ratio. So 40% of its earnings are reinvested in the company, and it expects to earn a return of 15% on those retained funds. So the 40% reinvested back into the business at a 15% return is a growth rate of 6%. Now we have all the variables we need to figure out the rate of return, the discount rate. So D1 is 4 divided by P0 of 40 plus 0.06 is 16%. That's the rate of return. So let's look at a couple of in-class problems now. ICP 11.1. Young Dutch Potato Chip Company paid a $1 per share dividend yesterday, and you expect that dividend to grow steadily at a rate of 4% per year. So 4 requirements. First, what's the expected dividend in each of the next 3 years? If the discount rate for the stock is 12%, what price will it sell at? What's the expected stock price 3 years from now? And if you buy the stock and plan to hold it for 3 years, what payments will you get? And what's the present value of those payments, and how does that compare to the answer in requirement 1? So to determine requirement 1, the annual dividends, D1 is going to be D0, previous or the current dividend, times 1.04. So $1 times 1.04 is $1.04. D2 will be that 1.04 D1 times 1.04, or we could take the original dividend D0 and multiply by 1.04 squared. That gives us 1.0816. For D3, we could take 1.0816 times 1.04, or we could take the original D0 times 1.04 cubed, or to the power of 3. So it's $1.1249. If we want to know what the stock price today is, we just use our constant growth model. P0 is equal to D1 divided by R minus G. So $1.04 divided by 12% minus 4% gives us a $13 stock price. Notice that we don't need to know what the other dividends are. We calculated D2 and D3 because we were asked, but we only need D1 to use in the model because the growth rate is constant. If I want to know what the stock price is 3 years from now, we modify that constant growth model where if we want to know what the stock price is today, that's P0. If we want to know what the stock price is in 3 years, that's P3. So if P0 is equal to D1 divided by R minus G, then P3 must be equal to D4 divided by R minus G. So we don't know what D4 is, but we can calculate it because we know what D3 is. So we could take 1 times 1.04 to the exponent 4, and that'll give us the same answer that taking 1.1249 times 1.04 is in the numerator, which is what I did. So that $1.1249 times 1.04 is what D4 is, divided by 0.12 minus 0.04, that gives us 14.6237. That's what the stock price will be 3 years from now. Requirement 4 is asking us for the present value of the future payments. So let's draw a timeline so that we know exactly what we're dealing with here so we don't get confused. So we have a 4-year timeline here. Our first dividend D1 is $1.04, D2 $1.816, D3 $1.1248, and D4 would be 1.215 if we took the 1.1248 or 49 times 1.04. P3 is the stock price at the end of year 3, which is based on the dividend from year 4. So if we want to know what the present value of those future cash flows are, all we need to do is factor in D1, D2, D3, and P3. We don't need D4 anymore because all we needed to use it for was to calculate the price of the stock at the end of year 3. Well, does this problem look a little bit familiar? And what function or calculator can we use to figure it out? Cash flows. So if we go into our cash flow function in the calculator and set CFD equals 0, C01 is D1 of 1.04 for a frequency of 1. C2 is dividend 2, 1.0816, it happens once. C3 is 1.1248 or 49, plus P3 of 14.6237. We have to combine those together to give us a total of 15.7486. And that only happens once. We can use the cash flow functions and the NPV at a rate of return of 12%. So set I equal 12 and then compute the NPV. That will give us P0 of $13. And guess what? That's the same as the current stock price today, which tells us that the price of a stock today is the present value of all of its future cash flows. Let's look at another ICP 11.2. Moose Jaw Industries has pulled off a miraculous recovery. So 4 years ago was near bankruptcy. Today announces $1 per share to be paid 1 year from now, first dividend since the crisis. Analysts expect the dividend to increase by $1 a year for 2 years. And after the third year, so by that time the dividends hit $3 per share, the dividend growth is expected to settle down to a more moderate long-term rate of 6%. So we have a constant growth dividend for a very short period of time, and then it levels off. So if the firm is expected to earn a return of 14% of the stock, what should its stock price be? Key, draw a timeline. Let's map our dividends. D1 is 1, D2 is 2, D3 is 3. I need to know D1, D2, and D3, and P3 in order to figure this out. To figure out P3, I need to know what D4 is. So P3, the price of the stock at the end of year 3, is dividend 4, which is dividend 3 times 1 plus the growth rate. So dividend 4 is 3.18. So the price of the stock at the end of year 3 is a $3.18 dividend divided by the 14% rate of return minus the 6% growth rate. And that gives us $39.75. So now if we take 1, 2, and then 3 plus $39.75 and put that into our cash flows in our calculator, we'll get $31.27. C of 0 is 0, C0 is 1 for 1, C02 is 2 for 1, C03 is $3 plus $39.75 for a total of $42.75. Using the NPV function at 14% interest, we calculate the PV, or P0, to be $31.27. So now we'll move into a variable growth DDM model as opposed to a constant growth. So variable growth is also known as a non-constant growth model. This type of model is used to value companies whose dividends grow at varying rates over time and really reflects the real-world assumptions that companies will experience different stages of growth, will experience different levels of profitability. So it's more accurate than other DDM models like the zero or constant growth model, but because we don't know what those rates are going to look like, they're still guesses. So we might use a constant growth model, assuming an average of different variable percentages that a company may have experienced over its history. So how do we value a variable growth stock? Well, we've kind of been doing it already. In essence, there are 3 steps. The first is to identify the growth phases. So we'll break that dividend growth into different periods that may have specific growth rates. So we can have a growth rate of 2% for 3 years, of 4% for 5 years. All we do is we just have chunks. We also want to be able to set what we call horizon year, and that's the year when the growth stabilizes. When the growth stabilizes, we're then able to use the constant growth model. So what happens is with a variable growth model, we have pieces of it that are non-constant and then has a constant piece at the end. The second step is to calculate the PV for each of those periods, and we'll forecast the stock price at the horizon. And then the third step is to add the discounted values from all of those phases to determine the intrinsic value of the stock. So we've actually already been doing this, but now we're just adding the complexity of periods where we'll have differing growth rates. So how might this look in a formula? Well, we could say that P0 is equal to D1 over 1 plus R to the 1 plus D2 divided by 1 plus R to the 2. And that keeps going on until we add what we call the horizon portion. So DH, which is the dividend at the horizon, plus PH, which is the price of the stock at the horizon, divided by 1 plus R to whatever year that horizon period is. Easiest way is to illustrate with an example. Let's say that BS is estimated to grow at a rate of 20% for the next 5 years, and then a normal rate of 8% thereafter. The dividend at the end of the first year is going to be $3. How much would you pay for this stock if the expected return is 12%? So stop the video and see if you can work through this. Give yourself some time. And the hint is to draw a timeline. So let's draw our timeline and put in our dividends. So D1 is 3, D2 is 360, D3 is 432, D4 is 518, and D5 is 622. So that's 20% growth. 3 times 1.2 is 3.6, times 1.2 is 4.32, etc. After that, the growth rate stabilizes. So that means D5 is actually the horizon period. And what we're going to do is determine the price of the horizon period, or P5, by calculating the next dividend. So the price at the horizon period of year 5 is equal to D6 divided by R minus G. We can either calculate D6 manually, as I shown in the timeline, to be 672, which is 622 times 1.08, or replace D6 with D5 times 1 plus G. Either way, it's 622 times 1.08 divided by 12% minus 8%. So 672 divided by 4%, or 0.04, is 167.96. That's pH. Using the formula that we just saw, here's how we would calculate P0. 3 divided by 1 plus 0.12 to the power of 1, 360 over 1.12 squared, etc. So we have D1, D2, D3, D4, 622 is DH, or 5, and the 167.96 is pH, the horizon. These are all individual lump sum calculations. So it's a lot of work to do that, 110.75. You could use your calculator and the time value of money functions that we've got accustomed to using. So 1N, 12IY, 0 PMT, $3 future value, compute PV, store it. 360 future value, 2N, compute PV, store it. 3N, $4.32 future value, store it, etc. But I think there's an easier way. Anybody want to guess? Cash flow function. So using your cash flows, CF0 is 0. C01 is a $3 dividend 1 for one period. C02, 360 for one period. C03, 432 for one period. C04, 518 for one period. And C05 is the horizon cash flow, which includes the dividend of 622 plus the price of the stock based on the constant growth rate of 167.96. So those add up to a total of 174.18. That happens once. Press NPV, enter 12% for your interest rate, press the down arrow, compute NPV, 110.75, which is the same as doing it the long way. The next one we'll just talk about briefly is a two-stage DDM model. So this values dividend stocks by assuming two distinct phases, an initial growth period that's at a higher rate. So let's say something that'll grow at 10% for the first 3 years, and then a second period of a lower stable growth rate. So this offers a bit more of a realistic approach to valuing mature companies that will transition from periods of rapid growth to more stable operations. This is a variation of the dividend growth model that we've been doing already, where instead of calculating individual lump sums for the varying cash flows before the horizon period, that second stable period is basically the horizon period. So the first period, we could use a constant growth rate for just that 3 or 4 year period, and then a different constant growth rate afterwards. I'm not going to do an example of one because, as I said, it's a variation of the variable growth model. In terms of advantages and limitations of dividend discount models, well, in terms of advantages, there's a sound theoretical basis for them. They're mathematically precise. There's no subjectivity around them. They're very objective. They can indicate the company's stability, and these are used all the time. So why are they accepted? On the downside, there are some limitations around, well, what dividend policy constraints look like. They can be irregular, and generally dividend policy is tied to earnings, and earnings isn't constant. So you don't always have a viable and predictable number to work by. Another limitation is that they're subject to a little bit of manipulation because dividends are paid in cash, and companies want to keep making their dividend payments even when it may not be appropriate and they may not be able to have sufficient cash reserves down the road. So while a company would prefer not to manipulate its dividend payments because it can lead to volatility, obviously, but they do manipulate the payments to keep the stock price up when there may not be a justification to do so. Let's hit a couple more in-class problems here, starting with ICP 11.3. So this is another non-constant growth model example. Fake news has been growing at a rate of 20% per year, and you expect that growth rate in earnings to continue for another 3 years. 4 requirements for this one as well. So requirement 1, if the last dividend paid was $2, what will the next dividend be? 2, if the discount rate is 15% and the steady growth rate after 3 years is 4%, what should the stock price be today? 3rd, what's your prediction for the stock price a year from now? And 4th, let's show that the expected rate based on our answers in requirements 2 and 3 equal the discount rate. So for requirement 1, the next dividend, pause the video and see if you can figure it out. To calculate it, we're looking for D1 here. So D1 equals D0 times 1 plus G. The most recent dividend is $2, so times 1.20 gives us D1 of 240. Requirement 2, what's the stock price today, P0? Again, stop the video and see if you can figure it out. So in order to do this, without a timeline, you can draw a timeline if you like, we need to know D1, D2, D3, and P3. So D2 is going to be D1 times 1 plus G, so $2.40 times 1.2, that's 288. D3 is going to be 288 times 1.2, so that's 3.456. P3 is going to be D4 divided by R minus G, or D3 times 1.20 divided by R minus G. So 3.456 times 1.20 divided by 15% minus 4%. So that gives us P3 of 32.675. P0 then, if we look at it the long way, is equal to $2.40 divided by 1.15 to the 1, plus 288 divided by 1.15 squared, plus, and that third term is key, the D3 plus P3, 3.456 plus 32.675 divided by 1.15 cubed. That's 2802. Now, we don't want to do things the long and hard way, do we? What we want to do is be efficient. So using the cash flow function, CF0 is 0, C01 is 240 for 1, C02, 288 for 1, C03 is that combination, 3.456 plus 32.675. That's a total of 36.131 for 1. If we use 15% in the NPV, so NPV, I equals 15, and then compute the NPV, 28.02. Requirement 3, see if you can figure out the stock price P1, so the stock price at the end of the first year. Again, pause the video and give yourself a chance. The reason why I showed it the long way in the last example is that if we show the same method for calculating P1, we'll notice that that first term where D1 divided by 1 plus 0.15 is now missing because we've moved one period down the timeline. So P1 is simply 288 plus 1.15 squared plus that horizon term 3.456 plus 32.675 divided by 1.15 cubed. If we think of our timeline, what we've done now is shifted 1 year down. So the D1 is now gone and we're looking at D2 and D3, which if we move one period forward actually become a new D1 and D2. D1 now becomes 288 divided by 1.15 to the exponent 1. And then we add 3.456, which is going to be D2, and 32.675, which is now P2 divided by 1.15 squared. That gives us 29.825. If we look at the cash flow functions, notice the green row is gone, and now we have C01 is 2.88 for 1, and C02 is 36.131 for 1. And if we compute the NPV now, 29.825. Now let me show you how to use your calculator to adjust the cash flows that are already in there so you don't have to input all the numbers in all over again. If you press the CF button and then scroll down to C01 where you see $2.40, you notice above the up and down arrows there's DEL and INS. Well, that's for delete and insert. So if you press second function up arrow, you can delete cash flow 1 and you see it ends up being 0. And then if you just press the down arrow, and then if you keep going, you'll loop back up to the top and you see CF00, C01 is now 288, which is actually the original second cash flow. Its frequency is 1. C02 is 3613, its frequency is 1. And now C03 is 0, which is what we want it to be. So press the NPV button. You'll see that 15 is already entered in the calculator for interest. So just go down to NPV, press compute, and now 29.83. And that's how you can delete, or if you're missing a cash flow, you can insert by doing the same thing. And then always just go back through the list to confirm all of your numbers are correct. For requirement 4, to prove the expected return, we're going to go and pull that formula that we had before, where R equals D over P0 plus P1 minus P0 over P0, and this is the dividend yield and the capital gain yield. We can combine them as well to where we have D1 plus P1 minus P0 all divided by P0. R is $2.40, that's D1, plus the P1 stock price of 29.825 minus the P0 stock price of 28.02 divided by 28.02, that's 15% in total. If we split that up into the dividend yield, we would take $2.40 D1 divided by 28.02, that's about 8.57%. The capital gain yield is the second term, P1 minus P0 divided by P0. So 29.825 minus 28.02 divided by 28.02, that's 6.43. And when you add them together, you end up at 15%. And our last ICP, 11.4. So let's say in early January, an investor wants to determine the maximum price to pay for shares in XYZ company. In 2024, the company paid a dividend of $1.25 a share. Recently announced a new product line that will revolutionize the industry. So investors believe that earnings for that company will be 8% for the next 2 years, then 12% for 3 years following that, and leveling off annually for an indefinite period. This is similar to the 2-stage DDM model. I guess you could say it's actually a 3-stage because we have 8%, then 12, and then levels off at 6. And in this case, the investor is looking for a return of 7.5% on all equity investments. So with that information, what price should the investor pay for those shares? So stop the video and see if you can figure it out. The hint, draw a timeline. So to determine the stock price P0, let's draw our timeline. We have D1 to be 135, which is D0 times 1.08. Then D2 is another 8%, so that's $1.4580. Then it grows by 12% to 1.633 for dividend 3, then another 12%, 1.8289 for dividend 4, and then another 12% to end up at 2.0484 for dividend 5. To figure out the price of P0, we need D1, D2, D3, D4, D5, and P5. But P5, we need to know what D6 is. So we would take D5 times 1.06, because now the growth rate settles at 6%. So 2.0484 times 1.06 is 2.1713. And we divide that by 0.075 minus 0.06, which is 0.015 or 1.5%. And that's a total of 144.7533. Instead of calculating individual lump sum present values for those, we'll jump right to the cash flow function of our calculator. CF0 is 0, C01 is $1.35. All of these are for one frequency. C02, $1.4580, C03, 1.633, C04, 1.8289, and C05 is the sum of 2.0484 plus the 144.7533. If we compute the NPV at a rate of 7.5%, we should end up with $107.457 for P0. And that's it for dividend growth models. All right, on to the next section of the chapter, this time dealing with discounted cash flow or DCF models. Here we'll look at what investor cash flows means. We'll compare DCF models versus the DDM model, and again, some advantages and limitations of this type of model. So when it comes to investor cash flows, remember that investors buy stocks to receive future cash flows. Plain and simple. When they buy stocks, they're typically looking for dividends. If the stock pays dividends, not all stocks pay dividends. Lots do. And there are some people that won't even look at a stock unless it pays a dividend. It basically pays you to own it. But all stocks will eventually, when sold, either generate capital gains or, unfortunately, if they're sold at lower than the initial price, capital losses. So if we want to determine what the intrinsic value of a stock is, can we say that it's equal to its initial cash flow divided by 1 plus R? So the stock value, if we replace D with CF for cash flow, is simply equal to the next year's cash flow plus the cash flow of the year after that, plus the cash flow at the horizon point, which would be the same as the dividend at the horizon, all discounted to their present value. I modified the Mayweather question from the textbook because the Mayweather one doesn't include a horizon value that's based on a growth model. So let's call this one Fairweather. It expects to receive a cash flow of $2 million at the end of its first year of operation, and that's expected to increase by 3% per year over the following 5 years, then grow at a constant rate of only 0.5% thereafter. So if we assume a discount rate of 8%, what's the value of Fairweather stock today? Let's map the timeline now. We should be getting really good at this. Notice here we're not using the word dividend, we're using cash flows. And when we get into the next week's session, we can be talking about free cash flows. So if we replace the word dividend with cash flow, the cash flow at the end of year 1 is $2 million. That grows by 3% to $2,060,000, grows again to $2,121,800, and you see the pattern here. So we have CF4, CF5, and CF6. That's based on the $2 million cash flow at the end of the first year, and then growing at 3% for the 5 years after that. So that takes us to the end of year 6. If we want to know what the value of that firm is today, P0 today, we have to factor in all those cash flows. And we know that after year 6, that 3% growth rate drops off to a stable 0.5% growth rate. This is actually an example of a 2-stage dividend discount model adapted to discounted cash flows. Conceptually, the dividend discount model is the same as the discounted cash flow models, except we're not dealing with dividends, and we'll discuss some of the other subtle differences later. So if we want to know what the horizon value cash flows look like, we need to determine the price or the value of the business, P6. And that's going to be equal to cash flow 7 divided by R minus G. Well, cash flow 7 is cash flow 6 times 1 plus G divided by R minus G. So we'll take that 2.318 million, multiply by 1 plus 0.005 because it's 0.5%, and then divide by the 8% minus the 0.5%. So cash flow 7 is 2,330,141 divided by 7.5% gives us 31,068,543. That is the horizon value. Now we have enough information to put in our calculator. CF0 is 0, C01 is 2 million, C02, 2,060,000, etc. C03, C04, C05 is 2251,018, and then C06 is the 2318,548 plus the 31,068,543. Again, all of those are frequency of 1. Always make sure you go back and double check you've got all your cash flows right. Hit the NPV button. 8% for interest. Scroll down, compute NPV, 29,480,232. So you would be willing to pay $29,480,232 for the company that'll start with $2 million in free cash flows at the end of next year, which grow at 3% for the following 5 years, and then grow at a steady 0.5% after that. So while mathematically, conceptually, the two models, the DDM and the DCF models, are basically identical, except we've just replaced the word dividend with cash flow. Not all companies pay dividends, and this allows us to value firms that don't trade publicly and have a stock value. So we can use the discounted cash flow model to value young, non-dividend paying firms, because instead of using dividends, we are using future cash flows generated by the business. This provides a standalone valuation that can be independent of industry comparisons, and it works from total firm value to per share if we divide by the number of shares outstanding. Some businesses will only have 100 shares if they're small businesses that are tightly controlled. So it doesn't make sense to use those kinds of share-based models in most cases. In terms of differences, well, the DDM model focuses solely on dividends, which makes them less applicable for companies that don't have consistent dividend payouts. It's just that simple. Whereas the DCF model looks at a company based on its actual cash flows as opposed to the cash flows that are paid out through dividends. The DCF model evaluates a company based on its cash flows as opposed to its earnings, because accounting earnings can be manipulated based on revenue and expense recognition policies. But when we're talking about getting down to cash flows, we can't manipulate how much cash there is in the bank and how much cash a company actually brings in and forks out. So some advantages of the discounted cash flow model include that cash flows are harder to manipulate than accounting earnings, so that builds some trust in the valuation. Cash flows are my favorite thing to look at with the business. The DCF is also valuable for companies that don't pay dividends, and they reduce reliance on comparisons with other companies. On the downside or limitations, companies can sell assets to generate cash even while they're experiencing losses. So we have to be mindful of what is the source of cash generated, which is why looking at the cash flow statement of a firm is really critical. Sometimes investors would prefer to reinvest cash for growth rather than holding excessive cash reserves. Firms can be vulnerable to inaccurate cash flow estimates or an unrealistic discount rate. These models are only as good as the information that we feed into them, so which leads to the last one around garbage in, garbage out. If we're using unrealistic rates, if we don't have good cash flow forecasts or estimates and growth rates, then it's not a viable model. So we have to be thoughtful in how we estimate and predict what those variables are going to be. And that's it for discounted cash flow models. The next section in the chapter is preferred stock. So we'll look at features of preferred shares, how to value preferred shares, and differences between preferred and common shares. This is a pretty easy section. So a preferred share is a unique type of equity. It's a share equity that offers preferential ownership benefits especially when it comes to dividends and claims to assets. So they combine features of equity and debt, equity in the sense that they're shared, they're own them, they can be traded. They usually don't have a voting component though, so usually there's a give and take when it comes to preferred shares. You give up the vote in exchange for a dividend. They behave more like bonds because of the constant dividend stream, but they're not secured. Preferred shareholders have priority in dividend payments, so they receive their dividends before the common shareholders do. And we can have dividends that are cumulative or non-cumulative. Cumulative dividends, if the company skips payments to its dividend holders, the company has to catch up on those dividends. Those are called dividends in arrears. The company has to catch up before it wants to pay a common shareholders dividend. And you wonder, well, how can dividends be skipped? Companies are not obligated to pay dividends. You can't force a company to pay a dividend, even if you have a preferred share. If there's no cash in the business to support paying the dividends, the company won't issue them because you could put a company into bankruptcy by forcing dividends to be paid out. The cumulative preferred share requires that the preferred shareholders get caught up before dividend is paid to common shareholders. In the case of a non-cumulative preferred share, those skipped dividends are lost and can't be recovered. So there's no arrears, nothing to make up. So if you're looking at purchasing a preferred share, see if you can get a cumulative preferred share. Some additional features. Generally, there's priority in liquidation. So in the case of bankruptcy or liquidation, preferred shareholders get a higher claim to assets before the common shareholders do. Of course, usually by that point, when you sell the assets, pay the liabilities, there's usually very little, sometimes nothing left, but you do get a priority in liquidation if you have preferred share. There's no maturity dates on them. So unlike bonds that have a maturity date, preferred shares do not have a maturity date, and they're only repaid if the company retires the stock or ceases operation. Usually what companies will do is make preferred shares callable, which means the company can decide to call them at their option. So if they've issued preferred shares, let's say have a dividend yield of 5% and decide that they want to recall those and issue new preferred shares with a dividend yield of 4%, they can do that. It's not really that much different than from companies that will call bonds that pay a higher percent interest and replace them with bonds that pay a lower percent interest. And in addition, preferred shares can be converted, not all of them, but some of them can be converted to common shares after a specific period of time. Now, why would you want to do that? Why might you want to do that? What we'll find out is the value of a preferred share is essentially based only on its dividend cash flow. And there really isn't any capital appreciation that comes from it because, as you'll see, a preferred share is a perpetuity. So in theory, at any point in time, as long as the discount rate that's used doesn't change in the present value calculation, a preferred share is worth $26 today and would be worth $26 next year. So there really isn't an opportunity for capital appreciation. So what somebody might do is take a 4 or 5% dividend yield stock that they get a nice regular dividend on. But if they think that the company is going to grow and see some significant capital appreciation on the market from the common shares, they'll convert that 5% dividend yield share to perhaps a common share that doesn't even pay a dividend at all, but may experience huge increase in share price and generate capital gains that far exceed the 5% dividend that's being paid on the preferred share if they didn't convert it. So how do we value a preferred share? Really easy, actually. Preferred shares pay a constant fixed dividend that's based on its par value. So the par value of the stock, if it's a $100 stock and it pays a 5% dividend, it's going to be paying a $5 dividend every year. Could pay it semi-annually. As a result, what you have is a perpetuity. So the valuation formula is really a perpetuity formula. So we can say that the price P0 of a preferred share is the dividend D over R. That's it. So here's a real simple example. Let's say that Well Health Services has issued some preferred stock with a par value of $1,000 and pays an annual dividend of 5%. If the market considers the risk of the company to warrant a 10% discount rate, what would the fair price be for that stock? So why don't you pause the video there and see if you can figure it out. So the formula is simply P0 equals D over R. From the information we have, we're not given a dividend, but we do have enough information to calculate the dividend. So we need to calculate the dividend, D, as the par value of $1,000 times the 5% dividend yield to give us $50. So now if we take that $50 dividend divided by the 10% discount rate, we end up with a stock price or intrinsic value of a preferred share of $500. Well, that's what the theory says, so let's see if we can confirm that this works in practice. Here's the snapshot of a Royal Bank of Canada preferred share that I took a snippet of in 2021. So it's a little bit dated, but it still gets the point across. On that date, the preferred stock is trading at $26.25. What we need to do is confirm that that is fairly priced. Well, the dividend that's being paid on that stock is 32.81 cents quarterly. If we take that 0.3281 dividend times 4 quarters, that's an annual dividend of $1.31. We're also provided with the dividend yield of 5%. So now we have the two components we're looking for. We have D, which is the dividend, and the yield of 5%, or R. So when we take the dividend of 1.31 divided by the 5% yield, that's a stock price of 26.248. Now, something interesting to note here is that in this graph, we can see that there is some variability in the trading range, and that is normal because of elements related to what we call systemic risk and just some general variability in the marketplace. However, you'll notice a very significant drop in and around February or March of 2020. Does anybody have any guesses on what might be the cause of that? COVID. So what this shows us is that even preferred shares, which should be consistently priced, are impacted by external factors. If there is a market crash, the price of everything will fall, even a preferred share. And then finally, if we look at some differences between preferred and common shares, we included this table from the text. If we look at dividends, common shareholders are only paid after the preferred shareholders. Preferred stock are highest priority, they get paid first. Common share dividends can also be variable. They may increase or decrease. During COVID or after the financial crisis, many companies scaled back their dividends. Some of them suspended their dividends. But preferred shares, the rates are predetermined, so the dividends are constant. However, the dividends can be skipped, which means that, again, if you hold a cumulative preferred share, you'll have to get paid out before the common shareholders get any dividends. And if they're non-cumulative, then the dividends are skipped. You get nothing. With respect to growth, as I said before, preferred shares won't grow. They're based on the present value of the only single cash flow, which is a stable dividend. Common shares will fluctuate based on all kinds of different factors in the marketplace, but at their most basic level should be reflective of what their earnings are. So if the company generates cash flows and earnings and profits and generates very large profits, that will result in growth in the share price for common shares, but won't affect the price of preferred shares. In terms of liquidation, preferred shareholders are given preference in terms of payments, so they're similar to bonds, and the common shareholders are the last ones to be paid out. Common shares have voting rights, preferred shares do not. Again, in terms of arrears, common shares, there's no accrual of missing dividends, whereas for preferred shareholders, only if they're cumulative. And finally, with respect to certainty, dividends are potentially not paid if the company earns no profits. With preferred shares, even if the company does experience financial losses, it may still pay dividends. That's not to say in all cases that companies that experience losses won't pay any common share dividends. Sometimes what they'll do is, in anticipation of things turning around, they may continue to distribute dividends if they have large cash reserves so that they can provide confidence to the shareholder that the profit situation is only temporary and that they're expecting it to turn around. If dividends are suspended and not restarted again, then that will have a significant impact on the stock price. And that's it for preferred shares. And the last concept in the chapter relates to efficient markets. This is a nice way to end the chapter on a light basis, just more some conceptual stuff here. So we'll look at a brief overview of market efficiency. We'll look at operational efficiency and informational efficiency. Market efficiency is the idea that ensures that stocks are fairly priced with minimal transaction costs and quick trade execution. So we've built a system around us that provides us access to good information, access to liquid markets where trades can be executed and settled fairly quickly. In essence, the goal is for investors to have the best available prices for their trades. There are two forms of efficiency. There's operational and informational efficiency. Operational efficiency simply just refers to the speed and accuracy of being able to buy and sell orders at the best available price. Over the last decades, we've seen some good technical evolution in the New York Stock Exchange and the NASDAQ that have shifted a lot more to either full electronic trading. We've also seen evidence of efficiency. So the public has access to best prices and fast order execution, which demonstrates operational efficiency in modern markets. We have the ability now with online brokerages to go in and get live stock updates. I remember the time when you'd have to look at the newspaper and see the stock quotes that would be published the next day. It's a different world now, so we can see what the stock price is on a live basis. Now, that may mean that some people are engaging in day trading, which they probably shouldn't, but that's a different conversation to have. If we look at comparing or applying this notion of operational efficiency to, let's say, cryptocurrencies, I think it's fair to say that crypto is not yet operationally efficient because there is a significant lag of time. And we're not talking about days or anything like that, but it could be a matter of sometimes 10 or 15 minutes where transactions, especially for Bitcoin, can be settled as opposed to them being instantaneous. When you combine that delay with the volatility of pricing of cryptocurrencies, means that you may have settled a transaction and expect to get a certain amount of money, but because of the volatility, you may get less or more when that transaction is actually settled into your wallet. So the technology is interesting and unique when it comes to the blockchain, but it's probably not as operationally efficient as stock markets are. Then we have informational efficiency. So we can say that a market is informationally efficient when its prices reflect all information, and that ensures that the stocks are trading at their fair value. And the impact on investors is that if the prices are not updated promptly, then they can become stale, and that puts investors at a disadvantage. While in theory, a stock should be priced based on its future cash flows, the dividend piece we can understand. It's that future stock price is the piece that is probably subject to the most uncertainty. And if we have all of the available information around what to expect in terms of the performance of the business, management discussion and analysis and perspectives, that we should all come to a similar conclusion around what we think the value of that stock price is going to be, and can then come to an agreement on a fair price and then make an exchange. But yet there's some factor in the market, be it hype, for example, is enough to make us question whether or not markets are really truly efficient. Because if all information is available, then there should be nothing to justify a stock price that is overinflated. So there are actually three forms of efficient markets. The first is the weak form, which basically says that current prices reflect the stock's historical price and trading volume. That's it. So if we want to use technical analysis, which means relying on past prices to predict future prices, we can't consistently outperform the market. The second form is the semi-strong form, where prices reflect all publicly available information. So fundamental analysis won't give investors an edge. Technical analysis is looking at the technical trading history of stocks to establish things like trading patterns or breakouts or those kinds of things. Fundamental analysis doesn't rely on historical stock prices at all. It basically looks at the financial analysis of the business, so all the ratios and cash flows and those kinds of things. So if prices reflect all publicly available information, then fundamental analysis won't give you an edge because we all have the same information. The third form is a strong form, and so all information, public and private, is reflected in the stock prices. So in that case, even insiders can't consistently outperform the market. So I guess you can tell me which one you think you believe in. I personally don't believe in efficient markets and really believe that the only one that we can utilize with some effectiveness is technical analysis. I'm not a believer in the semi-strong form because as an accountant, I know how accounting rules and policies can result in potential manipulation of earnings, not for all of the financial statements. So cash flow analysis is still a reasonable approach to take for fundamental analysis as well as some key ratios. So I'll leave it to you to decide if you think that markets are efficient. And none of these forms of market efficiency seem to capture anything related to the hype around stocks. So for example, why is Tesla, a company that has not been around for nearly as long as Ford and General Motors, doesn't produce as many cars as General Motors, why is it trading at so many times more than General Motors that has an established dealer network and all kinds of things? The company just hasn't provided, at least in my opinion, enough proof to justify why it's worth so much more than its peers, in essence. But I'll leave it to you to think about if you believe in efficient markets. And that's it for Chapter 11.